Well, as a normal course, declining interest rate environment would indeed be challenging for banks. And DBS has traditionally been associated with a high degree of correlation to the interest rate cycles. I think, Tanvi, one of the things that the market liked about our results yesterday is that we were able to point out that our interest rate sensitivity has actually come off quite sharply. On the way up, we had guided $18 to $20 million per basis points. But since then, we've been able to add a lot more duration, fixed rate assets to our books. And partly because of that, we've been able to bring down the interest rate sensitivity to as low as $4 million per basis point. What that means is that even if you wind up with a couple of hundred basis points of interest rate cuts, you will not see the impact on our bottom line that you would traditionally have expected. And I think the markets like that.
The other thing the city highlighted as well, which I think needs to be addressed, is how strong your operational performance has been and the operational trends overall in terms of reviewing your price to book and also reviewing your ROE premium over the course of your own tenure as CEO over the last 15 years. You know, just to give you a number out there for the benefit of our viewers, DBS's price to book expanded from 23% discount to peers average in 2009 to 36% in 2024, peaking at 50% this year by May 8th of 24, that is. So obviously there's been a marked move in your ROE, in your return ratios, and I wonder what that does for the dividend yield, dividend trend going forward from here.
Well, as you pointed out, our return on equity has been extremely strong. In fact, at this point in time, we are among the top 3 or 4 banks of the global 100 in terms of ROE. And that's obviously the big driver of our price to book. But our dividend yield, even at these prices, is quite good. As of yesterday's or day before's closing, our dividend yield was 6.6%, which is not shabby dividend yield. Now, having said that, we have pointed out before that we understand that we have a lot of capital. We're extremely well capitalized, and so we still have the opportunity of returning more capital to shareholders. And it is something that we are conscious of, we will work on in the course of the rest of this year.
Right. I also want to, Piyush, touch upon one of the other aspects that Citi highlighted, which was about, your exposure to Hong Kong property sector and what that means for your NPLs. What's the outlook thereof?
Well, I think the general consensus has been that our exposure to both China and Hong Kong has been extremely well managed. We have exposure to the Hong Kong property sector, but the bulk of it tends to be the Hongs, the really large and big conglomerates, and I don't think anybody sees too much trouble there. We certainly don't. There has been some increasing challenge in the sector, so we've had some migration, but the overall size of that book is quite small. And as a consequence, if you look at our NPLs and if you look at our specific provisions, they've been very low. In fact, our SPs for the first half of the year have been as low as 8 or 9 basis points, and that just reflects the nature of the portfolio and the fact that by and large we have things under control.
Mr. Gupta, how have you been looking at the recent market volatility out there over the last week or so?
Well, the markets have been skittish. I think the markets were primed for a sell-off. So I think the readings on unemployment caused a sharp sell-off. But I personally try to look through that. If you look at the underlying nature and shape of a lot of the other economic data and variables, it's not that different today from what it was a week or 10 days ago. There is some slowdown. PMIs have been under 50. Unemployment has been down. But at the same time, there continues to be a reasonable degree of robust demand. And so my own sense is that the market sell-off is a trifle overdone. And you saw that in the last day or two. You saw a correction in the market. I do think that you will continue to see a slowdown. I think the markets, might stay soft. But I don't see a cataclysmic, catastrophic sell-off coming either.